From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for October 4th, 2024. Back in the day, today was known as CB Radio Day. Well, 10-4, good buddy. Let's check the calendar. More Oktoberfests are happening this weekend. Kegel's Inn in West Allis is hosting an Oktoberfest. And at Cathedral Square, the Oktoberfest party includes a wiener dog beauty pageant. That's on Sunday. And I'm stopping in just before the Packers play the Rams in L.A. And the Brewers, oh my, as we are fond of saying, we'll get them next year. To start us off, I have a couple of stories about lost pets being reunited with their families. First, the Siamese cat named Rainbow dashed into the woods at Yellowstone National Park where the family was camping. They searched for 5 days, but nothing. 2 months later, Rainbow was found just a couple of hours from their family home in California, 800 miles away. No one knows how many lives she used up getting there. And the next pet was reunited with his family 30 years after his disappearance. Manuel the tortoise had been living on insects and termite larvae right above everyone's head. He was in the attic. And unlike Siamese cats, runaway tortoises, even if they could run, never get very far from home. And finally, from Austria comes this anti-drug nugget. A 37-year-old man suffered from depression and drug abuse. His drug of choice was magic mushrooms. He abused them to the point that he severed his own manhood with an axe. But there's good news. The doctors were able to reunite his two best friends. On the podcast today, we have Steve Giles, Tom Pappenfuss, and Joel Dresang. And wrapping up the week, here's Kyle Tedding.
Well, thank you, Max. A strong finish to the week to turn positive after a bit of a bumpy ride. The NASDAQ up 0.1%, closing at 18,138. That's up 18 points for the week. The S&P added 13 points, closing up 0.2% at 57.51. And the Dow Jones Industrial Average added 23 points for the week after adding 341 points on Friday. Finished the week up 0.1%, closing at the bell at 42,353 for the year, including dividends. NASDAQ up 21.4%, the S&P 500 up 21.7%, and the Dow Jones Industrial Average up 13.8%. Well, we got a pretty strong labor report today, Steve, a sign potentially that the economy is stronger than we thought. We seem to be saying that quite a bit lately. You seem to have quite a few pieces to add, but it's clear when we looked at the bond market today that potentially some signs that maybe the Fed has a little cover before they need to make that next rate cut. Or if nothing else, maybe some signs that rates right now, at least, about where they might need to be for a while, given that we still don't have an issue in the labor market, inflation coming under control.
Yeah, Kyle, it sure does paint the case that the Fed's been right all year long. Everybody giving them grief until September when they waited before they dropped rates for the first time this year by a full half point. Of course, today's labor market data suggesting that maybe the Fed doesn't have to be as aggressive in their next rate cut. I think the odds for a 50 basis point cut were shaved in half, and we now have perhaps a chance of maybe 2 quarter rate cuts in succession so the Fed can digest and so that the market can digest some of the news that we got. In addition to these numbers for the labor market, we had a revision upward on all those summer jobs numbers that this economy is a lot stronger than I think people were realizing.
So, Joel, maybe a good time for you to jump in because you took a good look at the labor market data this week. 254,000 jobs added in September from August. Again, a far bigger number than what we were expecting.
Yeah, and a lot of times the reaction to it is because of the expectations, but it's a good-looking number. It's above the 12-month average of 203,000, so it was the highest, I think, in 4 months. As Steve said, they added 72,000 jobs for July and August. as they revised the numbers, so it was looking stronger. But I always try to look at the other side too. I'm still seeing some signs that employment isn't as strong as it has been. The year-to-year comparisons on the household survey show that there are more people unemployed. There are more long-term people unemployed. There are more people who are working part-time for economic reasons, meaning, they'd like to get a job, they want to get a job, but they haven't been able to get a full-time job. And there are also more people who they've stopped looking for a while because they didn't have any luck getting the job that they needed. We had other numbers this week that also paint a slightly darker picture for the labor market. We had job opening numbers for August. In that, the number of quits, people who are voluntarily leaving their jobs, which is a sign of worker confidence, really, of finding other work. That's down below where it was before the pandemic for the 10th month in a row. A number out of today's report is the number of temporary help jobs, and that's sort of a harbinger of hiring trends. And that's been below the pre-pandemic level for 12 months in a row. There's another number in today's report that, if you look for it, it's called the U6 number. It's actually kind of an underemployment number where it looks at unemployment and a number of other factors, and that's been below the pre-pandemic level for 13 months in a row. And that's all to say that it's not as rosy as that one jobs number might seem, but it's also a reminder that going into the pandemic, we were in a pretty good place. So the fact that we're a little bit under that, a little weaker than that, actually might support the Fed's concerns about the labor market instead of inflation.
Well, unemployment did come down to 4.1%, and you also had wage increases. We saw a 4% wage increase, and when you factor that into where inflation has been trending, there's more money in consumers' pockets compared to there was a year ago, and that money's going to go a little bit further because the cost of goods and services is lower.
Right. That Adam Bailey is always happy to say that the wage rates are going up higher than inflation, and that's been the case.
I think that's the key, right, is more money in our pockets, more people making more money for working encourages more people to work, or at least those that want to work. We also have more and more people entering the ranks of retirement. And so the folks that are now no longer looking for work don't show up in that employment number. We look at things like participation rate and try to gauge, okay, how many of us fellow Americans are out there really in the labor force? That's been on a bit of a decline, longer-term trajectory. But when you consider that retirees, generally speaking, know where their spending is going to come from, they've got Social Security, they've got retirement savings, by the way, that have gone up pretty substantially, I think it's pretty safe to say that, at least for now, the spending piece of our economy, which we repeat ourselves, it feels like every week, but 2/3 or more of our economic output comes from that consumer spending piece. That spending piece appears still relatively stable.
Well, and I think it's also worth pointing out that in those jobs numbers that came out today, we had job growth in every sector except manufacturing. So you've got broad-based hiring across the board, whether it's government, construction, business services, retail, leisure, hospitality. It was only manufacturing that saw a decline, and the decline really wasn't that big.
There was good growth in bars and restaurants, and I always see that as a number that reflects well on the economy because, if you're not going to be spending money, you're probably going to cut back on going to the bar.
Yeah, the article I read said that there was an increase in the hiring in drinking places. So
we all try to do our part, Steve.
Yeah.
Tom, one of the things this week that stood out to me was a bit of a jump in Treasury rates, in particular Friday, in response to that unemployment, or rather that employment number. And yet you go back to kind of the Fed's action in mid-September, we finally saw a normalization of the yield curve, depending on how you measure the 10-year Treasury versus the 2-year Treasury. You'd been getting paid a lot more for a long time to think short term. And all of a sudden, as expectations shifted for where rates were headed, well, now you're finally making a little more to invest longer term. And so, I think there's some lessons potentially to be learned in, I think we called it the de-inversion of the yield curve.
Yeah, however you want to phrase it. I mean, we've gone about 26 months here with an inverted yield curve. And why we ever talk about that and its significance is it's usually been kind of an imminent sign of an oncoming recession. Obviously, that has not been the case, and this isn't necessarily a new thing. This has happened before. We've had yield curve inversions. It hasn't been quite the indicator of an oncoming recession before. But a particular note, to your point, Kyle, it's de-inversion with the 2s10s now with the 2-year Treasury slightly lesser yield than the 10-year. But also, to your point, the overnight rate, as we know, is still around 5%. The 3-month T-bill is still higher than the 10-year itself. So I think its significance in the de-inversion is that it's returning to a more normal yield curve. And I think that's important because we want to see longer-term yields be higher. It's just a general proxy or overall sign of economic growth and down the path and into the future. So I think it's a start of something that we're hoping to see a little bit more of a normalization as we try to get back to whatever that more normal or terminal yield is on the Fed funds overnight rate.
I think what I appreciate so much about interest rates is that you have this kind of very short end in the overnight rate that's exclusively controlled by one policy-setting body, right, by the Federal Reserve. And then you have these longer-term rates that are controlled almost entirely by investors, by the investor opinion of where is growth headed. And so you can have, for an extended period of time, this massive divergence between what's the Fed doing, what's the Fed need to see happen. Well, they wanted to slow growth. And then those longer-term rates that show, we think the Fed's going to win. We think that inflation is going to come back down. We think that the rate of growth is going to come back down, because if they didn't, they would demand much higher interest on those longer-dated bonds. And so I think we've seen in the data, we've seen in the rates themselves for a while that it was going to take some time, but eventually we'd see that normalization. I think healthy to see it finally here on the 10 versus the 2. And again, I think the further the Fed goes, the sooner we get to kind of that more normal environment. I think the one benefit, Tom, that you and I were talking about before the show to lower rates is it tends to drive returns for smaller cap stocks. Small cap stocks tend to be fairly big borrowers. They tend to buy floating rate or borrow floating rate rather, meaning that when rates are high, their borrowing costs tend to be high. And as those rates come down, it tends to respond. Also tend to be growing businesses, and when rates are high, you tend not to pay as much for those growing businesses. And so some signs that potentially, and we've seen it a little bit recently, but potentially lower rates drive maybe some small caps towards a little bit higher return than what we've seen.
Yeah, I think at this point in the stages, I think we can say we're fully engaged in a bull market run. With the gains we've seen in the S&P and other pretty much most markets across the U.S. stock landscape, you're constantly looking for where's the next best value, that you're looking for kind of the easiest path to find that. And so you're seeing the markets broaden out more. You're seeing, as we've noted in the past, utilities is one of the top performing sectors. Value stocks are doing better. Consumer staples, names that we're less familiar with, because this has largely been a rally, again, around technology growth stocks. And now we're starting to see some tailwinds behind small caps, some lesser appreciated areas. So people that are more diversified, that's been an area that, even Steve and I were looking at performance numbers over the last few years in small caps. It's largely underserved on what we might typically expect over a longer period of time. And so at some point, you kind of hope that comes around. And if people are kind of starting to hedge their bets, and I think performance in small caps over the last 3 months has been pretty good. You're starting to see investors go to other places, and I think it's just a better sign that, diversification is starting to win out.
Steve, maybe there's a little counterpoint there in that small caps certainly provide some opportunity over windows of time. The challenge, of course, is that there's a lot more volatility in small caps, and not everybody maybe wants to put up with that volatility.
Yeah, Kyle, nothing's for nothing. Be careful of chasing those sectors that look like they've done very, very well recently. As we all know, there is a regression to the mean when it comes to investing in any asset category. And I think we can see that most simply in the return divergence between value and growth just over the last quarter. While growth led the charge for the first 6 months of the year, it's value that has been outperforming for the last 3 months. And to that point, you also have a situation where small caps outperforming large caps over the last 3 months. A lot of times when you have a shift in a particular sector, most of those gains are made in the early stages, and getting in now might be too late.
There's a really good article in the Wall Street Journal talking about the opportunity in small caps, maybe some of the challenges there. One of the data points that really stuck out to me was the number of small businesses, Russell 2000. 42% of the Russell 2000 companies are unprofitable. It was almost unheard of to me. You compare it to the S&P 500, 6% of those businesses are unprofitable. And so I think there's a lot more potential just for companies to not be around, right? There's this survivorship bias of, well, the ones that survive are going to do great. But if 42% of them aren't profitable, maybe we have a lot of businesses in that small cap space that don't survive. And so what you're left with is, as they get bigger, okay, well, yeah, they're going to look stronger because they're the ones that had the business model that actually was going to make it.
Well, maybe the approach to, if it is an area of investing that you feel you want to take advantage of, maybe you just don't buy everything to that point, right? It's if you're going to have any chance at performing well in that space, or maybe trying to outperform just the index itself, you need probably a manager and a team of analysts to go at it to have that data to weed out those better companies.
Well, and that's part of our job, right, Tom? We're here to help our clients identify those opportunities, but I would also say that we're also here to help our clients identify their own tolerances for risk and the kind of swings that they want in the market. I think, as Art correctly pointed out at the seminar that we just had this week, you got to ask yourself the question: how much do you want to make versus how much are you willing to lose?
Well, and again, I think when markets are up, it's I want to make all of it, and when markets are down, it's I want to lose none of it. And so the challenge isn't just how do you answer the question today. The challenge for us is how well do we know you over time? How well can we help you to understand, yeah, okay, I understand you want to be fully in when everything's great, but things are going to turn. We have to have some humility and understand we're not always going to know what that looks like. And so how do we help you navigate a downside we don't even know is coming yet? I think the last piece of this, a big news item this week, we had a dock workers strike. It appears now mostly extending the current contract to get workers back on the job here through mid-January. But what struck me, Tom, about the conversation with these workers was that, yeah, salary is certainly a part of the conversation. Working conditions may be the bigger concern right now, in that they're worried about the role that automation, artificial intelligence, all the same things we've been talking about in other labor negotiations. Yeah, they've come right back to the forefront here with these dock workers. And so, maybe this even goes back to our conversation on, big versus small companies. Well, the big companies have been participating more in that automation, in that artificial intelligence. But what have you learned from maybe negotiations this week? And what have you learned more broadly about kind of the role that maybe some of that stuff plays in our investing?
Yeah, I think it kind of shows that you just can't forever fight progress. As much as you want to push back against it because it works against your own interests, you got to kind of find a way to work with it and use it to your advantage. Like I said, where one door, to use a terrible cliche, one door closes, one door opens. So with automation, innovation, anything that may happen, you create new roles, new responsibilities. There's new skills to be learned to make sure it's a useful part of your either your employment or find a new space within a company. There's always going to be new roles created. So I think it's one of those areas or learning opportunities you don't want to necessarily fight it, but find a way to work with it and manage it a bit better.
When we talk about the history of our economy, I think there's this tendency to look at the environment we're in right now, a month out from elections, and go, well, a lot of stuff's going to change. A lot of stuff's going to be, depending on your point of view, either really terrible or really great. And I think the reality is, our country has been driven by innovation, technology, business owners, especially small business owners, looking to that change and going, okay, here's an opportunity and here's how I'm going to take advantage of it. And so I think, if anything, I view that as growth opportunity, even if it is disruptive, right? Even if it means that people are going to be put out of work, that's a terrible thing, and we need to have real solutions for how we help our workers, our fellow countrymen and women navigate those issues. But at the same time, that's progress. That's the direction that the economy is headed, and it's the history of our economy. It's where we've been. It's where we're going. Joel, we've got a newsletter coming out here shortly. I think a couple of key points might be helpful for those that aren't getting it, to maybe encourage them to get their name on the list.
Sure, yeah. Just go to our website at landaas.com, Landaas, and we at the bottom there's a little item there you can click and just sign up for it if you're not getting it. And if you're a client, get in touch with your advisory team, and they'll sign you up. We'll get it in your email box every month, and it gives a quick click to a lot of articles that we're putting up there.
And you get reminders that way on what's going on here at the firm, on new faces. You get reminders here on things like the seminar that we have, one more next week on the 9th of October. If you haven't signed up, we'd love to have you out. We do have a little bit of room left. And beyond that, we enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.